What's up, everybody? Well, it looks the markets took a jolt on the JOLTS report. They got hammered early and are still under some pretty heavy pressure. I would think that at some point here they're going to find a bottom and we're going to get a rip your face off rally. However, I do believe that markets are going much, much lower going forward. But the JOLTS report that came out at 10 Eastern certainly sent the markets into a tizzy, and you can certainly see it by looking here. Look what happened here. Okay, they dropped precipitously down. And of course, we saw our pattern play, which gave some opportunities. There were some losing trades and some winning trades in there. But again, remember, the losing trades are, if you're managing your risk properly, then the losing trades are just a small amount of the overall picture. And I think you have to understand when you're trading that you must manage your overall risk. But at the end of the day, you can see on these short-term charts that crude oil is holding up well. The indexes are all selling off, still pretty solidly here. And I would think that what I would really like to see, if I could script it, would be tomorrow is the PPI number. Not PPI. Tomorrow is ISM services. Okay. I'd like to see the ISM services number be bad and have the markets get clocked early. And I think one of these mornings you're going to get a turnaround. And again, it's going to be, we call it a rip your face off rally, that they're going to squeeze the shorts into oblivion. And that happens often. That's really what you're expecting, because if you look at the bigger picture, okay, we look at markets and you can see that all the futures markets, the S&P, oversold. Okay. And let me just change this back to a 3-month chart. I think I put a year up there. Let me just make it a little bigger. There you go. S&P oversold. Okay. And Dow, way oversold. NASDAQ, probably not as much, but with today's action, still got some room to go. And the Russell, dramatically oversold. Okay, so what does that all mean? Well, again, we can't, I'm sorry. Let me go back and show you these. I forgot to show them to you. Here. Oversold Russell. NASDAQ not quite there yet. S&P oversold, and the Dow well oversold. Okay, so the two weakest indexes right now are the Dow and the Russell, which makes sense. But at the end of the day, okay, you get to a point where there's so many shorts in the market right now that at some point there's going to be something that's going to trigger a turnaround. And then it'll be like a bunch of rats trying to get out of a boat that's sinking. Okay. And again, really what that's going to be is an opportunity to sell. I think one thing that you have to take from what I'm telling you now is that we're certainly in a downtrend. There's no question about that. The markets are certainly ugly. There's no question about that. But what you want to take away from this today is understand that there's a rally coming somewhere. Okay. It may not be tomorrow. It may not be today. I can't tell you when it's going to be. But if you're trying to short down into this market, you're basically selling into the hole. And you really don't benefit from this. In fact, you'll create yourself into a lot of panic. But the best thing about markets that are either bear markets or down markets is the rallies are extremely sellable if you're patient to wait for them. And they're vicious, which gives you a lot more opportunity. You know, one of the things we've been lacking over the past 6 months is the real activity in markets for them to move. I mean, they haven't had dramatic activity. Well, now we're starting to see some. And in fact, this morning, when I was live trading with my members, I said that, we didn't have much this morning. We had a couple of trades, that were break even, small winners. But I said that look for some wild action because you can see it kind of coming in. Okay. And certainly we are now starting to see it as we look. And of course, is the Dow making a bottom for today? I don't know. We'll see. Again, I'm not looking to buy that. I'm looking to see when it starts to move higher. And if I miss the rally, I'm not concerned about missing the rally because I want to be a seller anyways. But if you look at the different patterns that are forming, the four major indices all down. Okay. The euro currency, after breaking down, okay, is now more in consolidation. The crude oil is now more in consolidation. Okay. Notes are headed to south, and gold is kind of in a similar pattern to of the euro currency. Now, gold has been under heavy pressure as well. Gold and silver and platinum. In fact, I did buy some platinum this morning myself, but gold and silver are extremely oversold as well. Okay, let's go back and look at those because, again, I want you to understand, again, it does not mean that you buy them today, but when you can find a reason that makes sense to buy them, you may want to look at it because there's, like I said, even if they're going lower, there's going to be a rally. I mean, gold is now going on its 8th day in a row lower in 9 out of 10. Okay, markets don't work like that. There's going to be some what they call mean reversion. Now, as you're looking at the Bollinger Bands here, the mean will go with the overall trend. So the mean will continue to fall lower. Okay, but there will be a bounce in where this will retrace and come back to the mean. Okay, and again, we don't know where that is, we don't know where that's at, but we do know that it's a matter of fact that it is going to happen. Okay, and it's just a question of trying to find it, but not trying to guess and find it. It really comes back down to using these shorter term charts. Whether you want to use, if you're trading on a daily basis, you're using a daily chart, then your short term chart is probably somewhere between 10 and 20 minutes. If you're trading what I'm trading, which is 4 minutes, then my short term chart is going to be 1 minute. Okay, and I think you have to understand that if you're willing to make sure that you put your exit point in. Okay, and I think it's very important to understand if you're willing to take the loss when it happens, because they're going to happen. They're not all going to be winners. But if you're willing to take the loss and you're willing to set your stop correctly, okay, then you take the trades because you only need one to be the runner, okay, or the no-brainer that will take care of any other heartburn or aggravation you have suffered throughout, okay? And you just have to have a number. And one thing you can use if you're not sure where to put your stop is use the average true range, okay, which is an indicator on anybody's charts, and use that as the indicator of where your stop is going to go. And basically what you would do is you would take the average true range and subtract it to the low of the bar if you're a buyer, or add it to the high of the bar if you're going to buy it, because you need to give yourself enough room to let the markets work. And I think I said that backwards. If you're a seller, you want to use the average range above the bar of where you bought from. And if you're a buyer, you want to use the average range below the bar in which triggered the buy. In other words, for example, in crude oil, okay, I use 60 ticks. Okay, so on a micro, that's $60. On a regular crude, it's $600. All right, I use 60 ticks. So if I were to enter, let's say I was a seller here. Okay, so the high of that bar was 89.34. So my stop would go in at 89.94. Okay, no matter where I ended up selling it, the stop is 89.94, and I would not move that stop until the trade could let me lock in at worst break even. Okay, that's our first move. Anytime we use a stop is break even. Okay, and of course, as we talked about last week, and I said to you that the VIX is going to trade over 20, and of course it got to 20 last week, and right now it's back at 20. Here you go again. So, and again, this is not rocket science. This is not something that is unusual. What you have to learn about the world of trading is how markets actually work. Okay, how the price discovery model actually works. Okay, hold on one second for me real quick. Okay. So if you're taking care of your business, okay, then you understand that markets get dramatic in one direction or the other. You're going to need, you're going to want to take the other side, not as a long-term investment for the rest of your life, but as a short-term trade. Again, you have to determine, are you trading or are you investing? There's a dramatic difference to that. But certainly when we look at the chart of the VIX, look at where it's hovering. And here's when I said that the first time that it would get to 18, and then I said it would get to 20. And again, did I know exactly? No. Did I know exactly the time it? No, because you really can't time the markets. But you do understand that there are trigger points within charts. And, we've done here, those of you who've been with me on a regular basis know that we've done what we call the blow up trade here. Okay, which is just looking. Now, we don't have anything happening right now. And if it happens, I'll make the trade with you sitting with me right now. I'm not afraid to trade at any time. Okay. But at the end of the day, okay, we want to make sure that we understand that we have to manage and understand what our risk is. Okay. Hold on one second, please. Okay, so we want to make sure we understand our risk and what we're going to do. But right now, there's not much to do. I mean, crude is breaking above here. Now, maybe it'll give me a trigger point to sell. Okay. Again, I need the volume to spike quite a bit more from here. And it's not going to happen because I've only got 6 seconds to go. Okay. The notes is not going to happen. So you can see that volume is already dried up. And one of the things when you're trading, what you want to look at is you want to look at the last, let's say, 5 to 10 bars. Okay. You want to look at the next 5 to 10 bars. Okay. Which means that, if I go back and look here, that this might have been an opportunity here. Now, I did not make any trade there. So again, I don't like to talk about trades that I don't make. Okay. I want to make sure that we keep ourselves always in the right position. So I will never tell you about a trade I didn't make. If I see something that was a potential, I will explain to you that it was a potential trade. But right now, the only thing I have on right now, other than my normal positions, is I'm short the bond market. Okay, which I'm not showing here, but I'll show it here. Okay, and because this is directly correlated to interest rates, and interest rates are rising, so these are going to continue to go lower. And I've been short, and I will stay short. And I will look to sell more. And if I were looking at this chart here, I would look to sell more right here. Okay, which is what I did. Okay, and certainly, I think that you have to continue to watch and manage the positions in your trading, because at the end of the day, it comes down to understanding the market footprint that is being left there. Okay, and hold on one more second for me. One second. Okay, so we want to make sure that we are identifying everything that we need to do to give us the highest probability of success. Okay, which means using the time frame that you're comfortable with, using a time frame that commensurates with the risk that you're willing to take. Okay, because again, the longer you go out in time, the more risk you have to expose yourself to. And there's nothing wrong with that. Okay, there's nothing wrong with the risk, but you cannot put yourself at risk if it's more than you can afford. You cannot put yourself in a position that you could lose your inventory, which is your money, and put you out of business. The key to trading, the key to what we do, okay, is to make sure that our inventory is good, so that we can stay in the market and we can continue to trade. Okay, that is something that is important to understand. Okay, is that the ability to trade, the ability to stay in the market, is more important than the winning or losing trade on the next trade. Okay, again, it's important that you understand that you're in this for the long haul. You're not getting rich today. Okay, you might get lucky today. You might make more than you thought you could make today, but you ain't getting rich. Okay, so you have to make sure that you're always protecting your inventory, which is your money. It's that simple when it comes to trading. So as we go back and look, and so let's see if there's anything worthwhile to look at while we're hanging out here. And again, I'm using this as my day trading model, which is 4 minutes and 1 minute. Well, there's really not much for me to look at right now. Okay, and I don't have to trade much, but I do want to move and change my stop in one of my trades that's open, that's profitable, which is in the bond market. Okay, but again, right now, the markets are not showing me any reason to be actively involved. Okay. So I'm not going to be involved. I'm going to sit back and wait. Okay. Now, if I'm looking at things here and I want to use a different method of trade, which you can, again, there's more than one way to trade. Okay. And in fact, I use about 10 different methods depending on whether it's an investment, it's a long-term trade, it's an overnight carry, or it's just a day trade. But I'm looking at these charts right now. I'm saying, okay, so if I were going to trade, I'm certainly going to look to get to the short side. So what would I be looking at? Well, I'd be looking for resistance in any market to potentially take a sale point. Okay. And again, then I would look for those markets to trade to that level, and then look for an opportunity, which then clues me in that I'm actually correct at what I'm seeing. And how do I do that? Well, I never know for sure, but I use then the 1 minute to determine the trade, right? So if I get a buy or sell signal, I then go to the 1 minute. If it's a sell signal and the 1 minute shows me a sell signal as well, I'm going to sell it. If it's a buy signal and the 1 minute shows me a buy signal, I'm going to buy it. And not until. So until the 1 minute tells me, it confirms what I'm seeing. And again, I don't have a trade to talk to you about right now because there is nothing going on. It's very quiet. Okay. So again, not a surprise with ISM services coming tomorrow, with jobs on Friday, next week CPI and PPI. I'm going to guess that when we get back together again, okay, we will have seen a rally of 2, 3, 4, 5%. Okay, which might have already failed by the next time we get here, but I think that'll be more likely by next Tuesday, not Thursday. And I would suspect that the lows that we now, okay, we will make lower lows. Okay, and that's something that I want you to remember at all times. Okay, is where are you? What are you trying to do? Because again, we go back to the simple thing of protecting capital, protecting your money. And all you're doing to do all that is to watch the chart, watch the footprint, and it doesn't matter what time frame you're using. Okay. But if you're watching the overall footprint of the market, you are saying, okay, I'm going to put myself in the highest position of probability. And again, for the method that I use more often than most, there is no trades happening right now. I have nothing to do right now. And I can either look at the price or I can look at the volume. I don't really care the direction right now. I need two components to trigger the trade: an expansion in price or a decrease in price, and a huge move in volume. If both don't occur, I don't have a trade. Okay. So right now I have nothing occurring. So I'm sitting here and I'm watching, I'm keeping it up in case something does come in the next 10 minutes. But at the end of the day, if both events don't occur, then I have nothing to trade. And I have to be patient enough to wait. I can't decide, well, I'm smarter than the market, I'm going to jump in. No, I cannot do that. I must be patient and calm enough to wait for my opportunities, because every time that I get impatient, every time that I try to force something, generally you're going to be a loser, you're going to lose money, and generally you're going to put yourself out of business or emotionally put yourself out of business. So you have to have a trigger point and a reason to trade. The more subjectivity you can take out of the markets and out of trading, the more that will help you take out more of the emotion that will keep you from failing, okay, in your trading work. Okay. Now again, as I'm looking here, you can see the Russell was close. Okay. And I will tell you the same thing I tell my members in the morning. If we were really busy right now and there was a lot of trades to be made, I might take a shot at something because I'm really busy. But right now it's really quiet. So why do I want to get involved in a quiet market? The same goes for crude. Crude is kind of close, but why would I want to jump in when there's really not all that much activity in the overall market? And these are things that you have to keep in mind all of the time, okay? Because this is going to be the difference between you being profitable and making money and you losing your ass, okay? These are the differences of discipline, okay? It's just watching and waiting for the opportunity or the method that you are using. Again, if you're using the MACDs, whatever you're using, it doesn't matter. But consistency and the ability to trade does matter. Okay, the ability to take the loss, because we all know there's going to be losses, right? There ain't no free lunch, kids. There's going to be losing days. You're going to have losing periods, and your ability to exit when you're wrong will make the days when you're profitable all that much better. Plus the fact that you won't be in bad shape and you won't make a bad decision. Remember, one bad decision trading leads to a whole series of bad decisions afterwards, which is why you want to try to make your trading as robotic as possible. Okay. So it's like the if-then theory. If this happens, then I'm going to do this. Okay. And that's it. If that doesn't happen, then I'm not doing anything. But sitting here and staring at the screen and staring at the machine forces a lot of people to see a mirage that does not exist. Okay. So again, it is my warning to you, okay, that you sit back and you wait for what you want to wait for. Forget about all the BS you hear out there. Forget about all the crap, all the billions that everybody tells you that they're making, because that's all garbage. Okay. And understand that it comes down to this little footprint. And again, the time frame is immaterial. Whatever works best for you, you can use any of it. Okay. And again, it comes back to how active do you want to be, or how active do you want to try to be? Okay. And of course, are you willing to forego your opinion? You know, there's an old saying that amateur traders want to be right, professional traders want to make money. Look in the mirror, ask yourself, well, who do you want to be? Do you want to be the one who's right and keep trying to chase that being right, or do you just want to make money? Okay. And understand that there's going to be bad trades, even if you do everything perfect. There are losing trades. Okay. Again, you can make a horrible trade that can turn out to be a good trade. You can make a great trade that can turn out to be a bad trade. But at the end of the day, the consistency of you being able to strictly follow a footprint or follow an indicator, whatever you're doing, when whatever works for you is what's important. And whatever instrument you want to use, whether it be options. Okay. Now, I do not recommend day trading options. Okay. Unless you're playing with the zero DTEs. But I don't recommend, as a rule, trading options, because I think that you're giving up too much of an edge to day trade on a short-term basis. Okay. I think you're giving up too much of the bid-offer spread. But you can try. But again, whatever tool you want to use, whether it be futures, whether it be the full equity, whether it be options, they all work. Okay. But what you have to learn is what works. What is the time frame that works best for what you want to do? Okay. Again, you can't force the market to give you trades in a stock or in an option on a 4-minute time frame. So you have to figure out what works best for you and what works best for what you're trying to accomplish. Okay. Because again, the game is about money. And if you chew yourself up with too much cost and too much giving up of the bid offer spread, then you're never going to make money. Okay. There's a lot of things that are very clear and very simple. Those are a couple of things that I shared with you. And again, we're still watching, obviously, and they're still seeing nothing going on. Now, why is nothing on? Well, that I don't know. Okay. But certainly crude oil looks like there's a potential that it could get there as a potential trade. You know, we'll know in about 4 minutes. Okay. But we'll see. And if it's a trade, I'm going to make it. I think crude's going to 100, but it doesn't mean that I would not be willing to sell it right now. Okay. If it gave me a sell signal. Right now, it's not giving me any signal right now. But if it gives me one, you can bet your ass I'm going to take it. Okay. Again, I don't worry about what I think when it comes to this. This is a long-term capital gain, and in this trading is 4 minutes. Okay. So I'm not going to worry about it. And it certainly looks like it's setting up. And right now, with the current pace that it's going, and one of the problems I do know in the market right now is the pace or the speed. But if the volume can spike up to here and this can keep going up, we will be selling it. Or I will be selling it. I don't know if you will, but I will be selling it. Okay. Again, that's something that is important. And I think that, if you get that, you will make yourself a happier trader. You'll look forward to playing in these markets. Okay. Because again, it's the ability to not make a bad trade. There's an old saying, it's better to wish you were in a trade than to wish you were not. Okay. So again, we talk a lot of things here, and of course we're watching as crude is going, straight up at the moment. Okay. And hey, look, if it, like I said, if it shows up in the next couple of minutes, we're going to make the trade. There's not an issue there. I got no problem pulling the trigger. Okay. I have zero issue at pulling the trigger on this trade if it does show up. Okay. All I can do is sit back and wait and watch, and it looks like it's got an outside chance to get there, but right now it still has not reached it. But notice the euro currency is selling off, but there is no volume, so I have no reason to trade. Gold is sitting around doing nothing. I have no reason to trade. Notes are doing nothing. I have no reason to trade. So the only market that I am potentially looking at right now is the crude oil market, because look at the volume. Notice the spike, bigger. It's the third right now. It's the fourth biggest volume bar of the day. Okay, which means that there's some emotional trading going on right now. Okay, and it means that there's some people there out there that are having some issues. Okay, maybe they're getting forced to get out. We don't know that. Okay, but certainly it is going to trigger a trade, and we're going to make it. I'm going to make a trade. But first, before I can make this trade, I first have to go and flip over the 1 minute, okay, which I can do now because the trade is confirmed that the volume is there. The price is there. Okay. So that is all confirmed. And I can go ahead and make that as a possibility. So I'm going to go over to my 1 minute. Okay. And what I'm looking for now is a sell bar. Okay. So right now, if I were looking at this, I'd say if it's below 89.66 in the next 8 seconds and it stays there, then I'm going to go ahead and sell it. But right now, it doesn't look like that's going to happen. It looks like it's going to continue to go higher, which is fine. Okay. Because again, I'm going to wait now. I get to wait until I'm ready to make that trade. Okay. That's the beauty. I get to wait until I'm ready to make that trade. Okay, and right now, so now it looks like it's going to be a trade, and I got to wait. I have to let the bar close to confirm, because if it could close, see, it's already bounced back up. So I can't jump it early. I have to let the bar close to confirm. And look what happened. If I had jumped in early, I'd already be losing. Okay, and I have not jumped in, but it still has a chance. I still got 25 seconds to go. Okay, so it could still become a trade, and unfortunately, if we do make this trade, I won't be here to put it to a conclusion with everybody, but I will tell you exactly what I did, and I'll report in on Thursday if I get it. But right now, again, I said below 66. We're at 68. So I'm not trading it. 66 or below. Okay. And it is not going to be there. Oh, it did get there. Okay, good. All right. Okay, my stop is going to be above the high, which will be 90.38 is going to be my stop. My entry was 89.66. 90.38 is going to be my stop. Okay. That's working now. So there's nothing for me to do right now other than to watch. Okay. I would like to see it hold this resistance right here. I'd also like to see it break down to that little bit of support level right there. Okay. But either way, that's just my first initial reaction to the markets. Okay. So in the meantime, I appreciate you all being here. I will report in. But if you did take the trade by some chance, if it trades down to 89.50, move your stop to break even and then try to make money from there. And until Thursday, thank you, everybody. I'll see you on Thursday. Have a great week.